Hello everyone, welcome to our discussion of Chapter 13 where we're going to look at risk and passive activity loss rules and then spend some time with the dreaded alternative minimum tax. A couple of areas in the tax law that most people would claim to be, I doubt anybody would claim to be their favorite issues, but we have to learn them, see if we can make some sense out of these rules. So let's jump in here. So first idea is the concept of at-risk rules. All right. So first of all, something has to be in the trade or business. So that's your or production of income. So the idea is, what if you invested? What could you lose? That's what is at risk. And you might help you understand that the reason why we have these rules is because people were able to create losses in excess under the old rules of what they put in. So they might invest $10,000, and because the activity borrowed a bunch of money, they actually lost more than the people put in, and so they could have losses that were more than what they invested. And these basic at-risk rules are basically designed to make it so that you cannot have a loss. And remember, these only apply to losses. This is nothing to do with when you make money. But if you lose money, you cannot lose more than you put in or that you've earned in the past. So you can increase the amount that you have at risk by earning or having success for some period of time. So let's look at how the amount at risk changes. So as you put money into a business, the cash and property amount that you put in, doesn't matter what form it takes. If you contribute building or whatever, or cash, same idea. And then your share of the liabilities, depending on who has to pay it back. Okay, so there's a share of the liabilities, and that can be a little different depending on the type of investment. But remember that if there's a possibility that you personally will have to pay back, then that's an amount that's at risk. So you put in money, that's at risk, you could lose it. But also, if you could be in a situation where you would have to put in more money, then that is also money that is at risk. Income and gain items change the amount of risk, so it increases it. So as you make money over year after year, the amount at risk goes up because you can now lose what you earlier earned or gained from the business. And then that amount of risk goes down. You cannot, once you receive the cash back, so if putting it in makes it go up, taking it out makes it go down. And if the liabilities is reduced or they're paid off. So now there's not the possibility that you would have to ante up more money. And so therefore your amount at risk has gone down. So Form 6198, lovely form, is about the activities subject to this risk, showing the different areas of debt, especially recourse debt, meaning that it can come back and you have to pay for it. If the company can't pay, that they can come after you to be paid as the investor. Non-recourse debt, where that is not the case. And then qualified non-recourse debt, which has to do with real estate and the idea that while you may not have to personally write a check, you may lose real estate or other assets in the business. So it can still be at risk. So if you lose more than you put in, if you, by borrowing money or some other way, lose money that you more than you put in, that amount, those losses are carried over indefinitely. Okay, so until you die. And then if you do something in future years to make your amount at risk go back up, or there's income in a subsequent year, you can use that carryover to offset that and utilize those carry forward losses. But they still could be subject to passive loss limitations. You always do that risk rules first, then you look at the type of activity. So this applies, at risk applies to any activity. Passive, active, doesn't matter. All activities are subject to the at risk rule as long as they're business or production of income. All right. So now we look at a smaller subset. So we have a situation, a business where the amount at risk has been determined. We know how much the loss is allowed based on the at-risk rules. So now we look at the type of activity to see if it is subject to the passive activity rules. Again, another way to prevent you from deducting losses where you really don't lose anything. So here's the idea of a passive activity. Does not materially participate. So this is the magic word, materially participate, when it comes to determining whether something is active or passive. Material participate means regular, continuous, substantial basis. All right, your job is you material participate in that, okay? But things like rental activities and being a limited partner in a limited partnership are usually looked at as passive. In fact, the law says basically, unless you can prove otherwise, we talked about that real estate professional exception to this, but outside the exceptions, this is the situation. They are considered passive, meaning we assume they do not materially participate. So they don't do these three things, okay? So there's some rules, of course, about how to prove that it's not passive, that something is active. And so how do you do that? So to get to material participation, all you have to do is meet one of these 7 tests. And notice the last one is facts and circumstances, which means you can still make a case even if you don't meet any of the other ones. So it's got to be greater than 500 hours, all the participation. So you could have you could still be active and have material participation in an activity that only took you 50 hours, as long as you are the only one and you participate all of it. So if you have a business and you do let's say you do some consulting and you do it for 50 hours in a year, you're the only one. You're all the participation. So it's you're still materially participating. Okay? Or it could be over 100 hours and not less than any other person. I mean, you're more than anybody else. There are other people in the activity, but other employees, other partners, whatever, but you have more than any of them. Okay? 100 hours and several activities, and they aggregate. So if you have multiple activities, you can aggregate them up to get your 500 hours. Okay? You passed this test for 5 years out of the last 10. All right, and if it's a personal service activity, meaning you provide something like legal services or that sort of thing, those are the types of things which are considered personal service activities. So, if you don't meet the rules for material participation, then regardless of what the business is, okay, then you have a passive activity. All right. Passive losses. If that activity loses money, meaning more expenses than income, you can only deduct the expenses up to the amount of the income. Any additional expenses are passive losses and must be carried over or applied to other passive activities. all right? Because you cannot take passive loss and offset portfolio income. You cannot take passive loss and offset active income. So your job and a active, materially participating business is active income. Portfolio income is interest and dividends primarily, capital gains. Passive income are those from those things. Now again, if it's a passive income, it's taxable the same way as any other income. It's only the losses where this special situation comes in to play. All right? So law, that's why we're referred to as PAL, or passive activity loss rules. They don't just say passive activity rules, passive activity loss rules. So back to the idea of rental activity. This is tying us back to Chapter 8, where we learned about rental activities. The assumption is that rental activities are passive. We talked about the real estate professional exception in Chapter 8, the 750 hours and more than half of your activities. That would make it active. You can see that is a far higher standard than these standards. So yes, you can have rental real estate activities that are material participation, but it's really a much more difficult standard. There are other areas when what might you think of as a rental might not be considered rental. It may not be automatically passive. Where the rental period is less than 7 days, like a motel or an inn or a bed and breakfast, those are not automatically passive. 30 days or less with significant personal services, like a hospital. I mean, technically, when you go stay at the hospital, you're renting a room. But they're saying because what you're really there for is the personal services, you want the nurse and the doctors and stuff like that, that is not a situation, that is not a passive activity. Okay? Where the rental activity is incidental to the non-rental activity, customarily available during defined business hours, like a gym or a golf course. Those are technically, you're renting the gym for a period of time, the gym equipment, but because it's open for during various time, the gym is not considered a passive activity. All right? Or it could be a situation where you rent to an entity the taxpayer owns. So you own a building and you rent it to your hardware store business. That hardware store business, because it's active, could also make the rental activity not passive as well. If it's passive, and this was brought up, say you can't fit it into the material participation rules. If it's rental real estate, then you can have a loss, okay, of up to $25,000. This has to be real estate. It can't be machinery or anything like that. You must at least be part active participation. Now this active, I know we use the same term in the tax law as the difference between active and passive, but this active participation is not make it an active, it's not the same definition as material participation. This is just active participation. And this means that you do some of the supervising of the rental property, meaning you don't turn all the decisions over to a management company. You choose who rents it from you, you maybe collect the rent, you decide who's going to fix you don't have to do all of the repairs on the rental, but you have to at least decide who's going to do that. Okay, that sort of thing. So unless you've hired a management company and had them just do it all and just send you a check for what's left over, then you probably have active participation. You have to loan at least 10% of the property. Okay, but remember, it phases out by half of the amount that you're over 100,000. So when does it go all the way away? At 150,000. So every dollar you go over 100,000 AGI reduces this loss by 50 cents. So if you're over by 12,000, then you're going to reduce this loss by 6,000. So you could only deduct 19,000 instead of 25. That's how that phase out works. There is some light at the end of the tunnel. If you have passive losses on an activity and they're carrying forward, remember they get to carry forward forever. At the point that you actually sell the passive activity, you sell that rental activity, you sell that business that's passive, and at that point you can take all the past passive losses against non-passive income. It's like they come back to life, all right? And this does not happen if you give it away or you pass it on as death. You actually have to sell it, okay?